Greetings everyone, I'm Michael and this is Credit Kuri, where we talk about credit, finance, and investments. In today's video, we're going to be talking about how to start investing in 2023. Investing can be one of the most complex concepts in personal finance, but it's also one of the key cornerstones to financial independence and wealth building. While it may be intimidating for some alpha soup terms like IRAs and 401ks to keep track of the latest market movements, understanding the basics can boost your confidence and help you feel comfortable getting started. How to start investing. On a high level, investing is the process of determining where you want to go on your financial journey and matching those goals to the right investments to help you get there. This includes understanding your relationship with risk and managing it over time. Once you understand what you want, you just have to jump in. You can decide to invest on your own or with the professional guidance of a financial planner. Today, we will discuss in detail each of the key steps to help you get started with investing. Number 1, decide your investment goals. Before you decide to open an account and begin comparing your investment options, you should first consider your overreaching goals. Are you looking to invest for a long term, or do you want your portfolio to generate income? Knowing this will narrow down the number of investment options available and simplify the investing process. Understanding your goals and their timelines will help you determine the amount of risk you can afford to take and which investment accounts should be prioritized. You also don't want to invest your emergency fund into a brokerage account because it's not easy to access money if you need it quickly. Plus, if you need the cash when the market is facing a downturn, you might end up losing money when you're forced to sell low. Number 2, select investment vehicles. After determining your goals, you need to decide which investment vehicle, sometimes referred to as investing accounts, to use. Keep in mind that multiple accounts can work together to accomplish a single objective. One important thing to note, opening a brokerage account and depositing money is not investing. It is a common mistake for new investors to assume that opening the account and adding money is enough. However, the final step is to make a purchase. Number 3, calculate how much money you want to invest. As you decide which investment accounts you want to open, you should also consider the amount of money you will be investing in each account type. How much you put in each account will be determined by your investment goals outlined in the first step, as well as the amount of time you have until your plan to reach that goal. This is known as time horizon. There may also be limits to how much you can invest in certain accounts. Number 4, measure your risk tolerance. Risk tolerance describes the level of risk an investor is willing to take for the potential of a higher return. Your risk tolerance is one of the most important factors that will affect which assets you add to your portfolio. Number 5, consider what kind of investor you want to be. There is no one-size-fits-all approach to investing. The type of investor you want to be is directly tied to the risk tolerance and capacity, as some strategies may require a more aggressive approach. It is also tied to your investing goals and time horizon. There are 2 major categories that investors fall into: short-term investing, also referred to as a trader, and long-term investing. Number 6, build your portfolio. Once you've determined your goals, assess your willingness to take risks, decided how much money you have to invest, and what type of investor you want to be, it's finally time to build out your portfolio. Building a portfolio is the process of selecting a combination of assets that are best suited to help you reach your goals. Here's a list of common investments to include in your portfolio. Stocks. This is an asset representing ownership in an individual company. If the company does well, the value tends to rise, but the opposite is also true if the company falters. Bonds. These are loans made to a company or government with the promise of repayment plus interest payments. Mutual funds. These assets are investments that are built to pool the collective funds of its shareholders to invest in a collection of stocks and/or bonds. And ETFs, exchange traded funds, are very similar to mutual funds and offer the same benefits, but typically with lower fees and more opportunities for trading. Number 7, monitor and rebalance your portfolio over time. Once you've selected your investment, you'll want to monitor and rebalance your portfolio a few times per year because the original investments that you selected will shift because of the market fluctuations. Other key things to know about investing as a beginner. The process for investing does not need to be complex. A best practice is to limit investment decisions rooted in speculation, panic, or fear, as these feelings can often lead to a significant loss or higher risk. The important thing for new investors is to take things slow and strive for consistency. And that was our video. Do you have any tips for beginning investors? If so, please share them in the comments below. Thanks for watching and enjoy your day.